So we're going to move away a bit now from looking at breaking down our total or mixed cost into fixed and variable. And in this problem, we're looking at preparing our income statement using the absorption cost method and the variable cost. And obviously, you're going to have a different outcome. So the first thing we want to do is requirement 1. It says compute the cost per meal under absorption costing and on variable costing methods. So under absorption costing, the main difference between absorption and variable, absorption includes your fixed cost presented on a per unit basis. So your fixed overhead for January was 700,000 and 2,000 meals produced, 35 cents per meal. In February, again, your overhead is still $700 a month, but now you're producing 1,400 units, so the cost is 50 cents per meal. So under absorption costing for January, the cost per meal, including both your variable and your fixed cost, is $5.35. Under variable, it's just, of course, your variable cost is $5. Whereas in February, you can see that you have a higher cost per unit, and that's because you have your fixed cost in February spread over a fewer number of units. So that has the effect of actually increasing the cost of the meal because you're spreading out your total fixed cost of $700 over fewer units, which actually has the result of increasing your cost per unit. So February under absorption costing is going to be more. It's going to be $5.50 for absorption compared to $5 variable costing. So requirement 2 is asking us to prepare the income statements for January and February using absorption and variable costing. So our sales revenue, so in January, you are looking at your sales. Now here, although we produced 2,000 units in January, we only sold 1,400 meals. So 1,400 meals, $9, that's where the 12,600 is coming from. Beginning finished goods inventory. In this case, we're not told anything about the beginning inventory, so if you're not given a figure for it here at the beginning, you have to use 0. So the cost of the goods that you manufactured, they made 2,000 units, and under absorption costing, it's $5.35, which we just calculated, $10,700. Your ending finished goods, it's got to be 600 because you made 2,000 meals, but you only sold 1,400, so the difference is the 600. That's what you had left. So 600, and they're valued at $5.35 each. So you're going to subtract that. So what you had available for sale is everything that you made, less what you had in ending inventory will give you your cost of goods sold, which is your $74.90. Subtract that from your $12,600 would leave you with gross profit of $5,110. The next thing you're going to want to do is deduct, of course, your operating expenses. And here we have operating expenses comprised of 2 elements. You've got your fixed and your variable. So your variable marketing and admin expenses, it's $1 per unit. So it's $1 per meal. So you sold 1,400 times $1 plus the fixed marketing and administration costs that were given in the problem is $500, so $1,900. So operating income is $32.10. So for doing the same thing, but for February, so for February, here our sales in February is 1,800 meals at $9 a meal, so our revenue is $16,200. Here we have beginning inventory. So we know that from January, you'll recall that we made 2,000 units, we sold 1,400, so we had 6 left over. So whatever you had left, so this is your January ending, so it becomes your February beginning. Plus, you produced in the month of February 1,400 units, so total units available is 2,000. We sold 1,800, therefore you had 200 left over. So our beginning finished goods inventory comes out to be 3210, which is which is what we had calculated back here. You don't need to redo it. So our ending inventory, the 600 units, 535, is 3,210. So that's your inventory at the end of January. So that, of course, becomes your beginning inventory at the beginning of February. Produced 1,400 units, but now you see the price per unit in February is $550, not $535. So the beginning inventory is calculated, the 600 times your $535, because that's what the price was in January, but now in February the price is $550, 7,700. So total available for sale 10,910, and your ending inventory is 200 units. We just calculated that, $550 a unit, $1,100. See, we have gross profit now of $6,300. Now we have to deduct our marketing and administration. So it's 1,800 units times $1 per unit plus the 500 will give you 2,300. So operating income here is $4,090. So that's under absorption costing. So the next thing we have to do is do the same calculation for your income statement. So prepare an income statement, but use variable cost only. So for January, of course, your revenue is the same. Now we're looking at your cost per unit is $5. Remember, because you're only looking at variable cost. So the goods that you manufactured, you made 2,000 units at $5, 10,000. Your ending finished goods inventory is only going to be valued at $5 because we're just using variable cost. So your total goods sold, variable cost of goods sold, 7,000 plus. Now you're including your sales commission because that's a variable cost. So when you're using variable cost to prepare your income statement, it's all variable, both the manufacturing cost and any marketing or sales commission costs. So 1,400 units times $1, 1,400. Now you have a contribution margin of 4,200. So now you subtract all of your fixed costs, both your fixed manufacturing and your fixed marketing and administration. So you're given the 700, you're given that in the problem, and the 500 as well. So under variable costing, the income is going to be $3,000. And again, you do the same thing for February, and I won't redo February's because it's the same calculation that you're using here that you did in the previous problem. So you can read that part on your own. And part 3 as well, I'll leave you to read that on your own because there's no calculations involved in part 3 of this problem. So that concludes 6-72.